What will markets and rates look like in 2025? Who's most concerned about Trump risk and where are the best places to invest your money this year? Happy 2025, member Super Savers and Bond Course fans. I hope you're healthy and well. What better way to kick off the new year than to talk about the market predictions for 2025? Our Diamond NestEgg regulars have heard me say often, I don't have a crystal ball. Well, I do now. Marcus actually got me a crystal ball for Christmas, but alas, it doesn't work very well in telling the future. So we'll have to go with the 2025 market predictions from Vanguard, Fidelity, and Schwab. How similar or different are the perspectives from the top 3 brokers that our Diamond NestEgg community invests with? And what are some of the best fixed income opportunities at the moment? With that in mind, here are the 3 topics that we'll be covering in today's video. 1. Will the U.S. economy's good luck continue? Meaning, have we really achieved a soft landing or not? Because this question, the macroeconomic outlook, this is the basis for all investment decisions. If the U.S. economy does well overall, we as investors in the U.S. economy will also likely do well overall. And if the U.S. economy does not do well overall, we as investors in the U.S. economy will also likely follow the same fate as our economy, or have to look for possible alternatives. Plus, we'll also cover which of the 3 leading brokers that we're talking about today is most concerned about our money and political risk, Trump risk, in 2025, and which are not. 2. What will be the likely terminal Fed funds rate? The terminal Fed funds rate is the ultimate target rate that the Fed sets for a cycle of rate hikes or cuts. In other words, at what level will the Fed stop cutting and hold rates steady? And 3, what are some top bond investment ideas for 2025? This is one section you won't want to miss because it gives you a glimpse of some of the topics that we'll be covering in greater detail in the coming months for those of you interested in higher yielding fixed income opportunities this year. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. At the current time, there is pretty much consensus that our country has avoided a recession and is now in soft landing territory. Our economy is anticipated to slow slightly in 2025 relative to last year, but the good news is that we're still expected to grow quite a bit faster than most other developed countries. This table shows the growth forecasts for 2025 for the US, the Euro area, and Japan from the OECD, the Organization for Economic Cooperation, and the IMF, the International Monetary Fund. So based on these numbers, it does appear that the U.S. economy's good luck will continue this year. And because I know this will come up, here are the estimated growth numbers for China as well. Yes, China is growing faster, but keep in mind that China is not considered a developed country like the US, the Euro area, and Japan. While China has definitely built an overall impressive economy over the past few decades, its GDP per head is still in the same range as Mexico's, according to the latest IMF numbers. Plus, China is also slowing and dealing with substantial challenges of its own, such as a housing bubble, rising public debt, an aging population. I could keep going, but let's save China's economy for a separate video and get back to today's topics, our economy, and our bonds for 2025. So while there is broad agreement that the U.S. economy's good luck will continue this year, there's less agreement around whether our economic resilience is really just that, sheer luck that will run out at some point, or whether there are fundamental and sustainable drivers behind this growth. Vanguard, Fidelity, and Schwab are not in complete agreement on this either. Let's compare the 2025 market outlook from Vanguard, Fidelity, and Schwab to show you what we mean. In terms of U.S. economic resilience, Vanguard stresses that there are fundamental sustainable drivers behind our country's growth, structural advantages which the U.S. has that other countries don't, which could result in further economic expansion. From Vanguard's market outlook for 2025, if we scroll down to this section, U.S. economic resilience has not been driven by Fed policy. Rather, continued U.S. robustness may owe more to fortuitous supply-side factors, including higher productivity growth and a surge in available labor. The rest of the world has been less fortuitous. Economies outside of the United States have been less lucky on the supply side, and thus unable to achieve the same combination of strong growth alongside significantly reduced inflation. Similar to Vanguard, Fidelity expects the following. The near-term strength of the U.S. economy and markets should continue for 5+ years, with some possible negative surprises, although Fidelity does discount political risk, namely Trump risk. From Fidelity's webinar, the U.S. exceptionalism story, I think, still has legs. The U.S. is a great place to invest. It's got great companies, better earnings power. It's lowered its tax rate in recent years. It's competitive. It's got a great workforce. It's highly educated. So the U.S. is still probably a place that's going to have better growth opportunities compared to other developed markets. And Schwab, surprisingly, Schwab did not have much to offer on this topic except good luck figuring this one out. Unlike Vanguard and Fidelity, Schwab has placed a big emphasis on uncertainty and ambiguity due to Trump risk. President-elect Trump's policy proposals have always sparked intense debate, but the extreme uncertainty surrounding them and the myriad associated cross-currents have made it difficult to forecast their impact on both domestic and global conditions. It leaves with an outlook that can be summarized by this bunch of characters that I didn't get initially. I gave up on becoming an artist when I was 12, but I did figure it out after a few moments. It's a stick figure shrugging. So basically, Schwab's prediction on U.S. economic resilience is we don't know. It's okay though, because Schwab's 2025 market outlook does get better as you keep reading, but more on that towards the end of the video. For now, let's move on to the next section of today's video. So, as I said before, the terminal Fed funds rate is the ultimate target rate that the Fed sets for a cycle of rate hikes or cuts. In other words, the level at which the Fed stops cutting and holds rates steady. So what should we expect for the Fed funds rate for next year and maybe beyond? Here again, Vanguard is the most optimistic, at least for those of us rooting for higher coupons on our new treasuries and other types of bonds. We believe that yields across the curve are likely to remain above 4% in the US. So the terminal Fed funds rate forecasted by Vanguard is 4%. Schwab has pegged the rate at between 3.5% and 4%, which is in line with the broader market, and Fidelity has projected 3.75%. All of these numbers are more or less in range with the Fed's own target rate of 3.75% to 4% by the end of 2025. Vanguard as well as Fidelity expect a good year for bonds and cash, driven by an interest level that will most likely stay higher for the foreseeable future than many market observers were predicting just a few months ago. And this expectation that we will see the rates higher for longer comes from the continued economic growth, no recession scenario, as well as persistent, stickier than expected inflation. Whereas we first talked about the generational opportunity in fixed income in 2023 and 2024, Fidelity sees this generational opportunity in fixed income happening this year in 2025. Schwab also sees support for bond yields as well from higher rates, but expects that another bumpy ride is in store for fixed income investors in 2025. And let us not forget the backdrop, skyrocketing equity valuations. This chart shows U.S. stock market valuations from 1928 to today, looking at the ratio between company values and actual revenues. Today's stock market is a very expensive one by this measurement, as we can see. Even if the long-term optimism about the U.S. and global economy is justified, the frothy heights of the current stock market are making many observers and investors somewhat nervous and hesitant to keep throwing more money into equities. So no surprise then that bonds are coming back into focus. And the question then becomes, which bonds for 2025? Which brings us nicely to the next section of today's video. Vanguard, Fidelity, and Schwab all offer some interesting bond investment ideas for 2025 in their market outlooks, although in this instance, Fidelity and Schwab shine quite a bit brighter than Vanguard with how specific they get in their recommendations. Vanguard proposes no detailed investment ideas from what we could see, but they offer a model portfolio for valuation-aware investors, as Vanguard calls them. These are investors who actively take into consideration the market value of assets, companies, and investments when making decisions. Or in other words, valuation-aware investors follow a general strategy, but give themselves a bit of flexibility to adjust and change their asset allocation over time. For example, to buy less overpriced equities and invest more into attractive-looking bonds instead. For Vanguard's 2025 model portfolio, this means that they would clearly overweight fixed income at 62%, but keep only 38% in equities, as you can see here. Moving on now to Fidelity. Fidelity recommends high-quality, low-risk investment-grade corporate bonds, like the retail notes that we've been sharing with you in recent months on this channel, which have been consistently yielding in the high fives and low sixes. They also suggest taking a look at mortgage-backed securities from GSEs, government-sponsored enterprises such as Fannie Mae and Freddie Mac, and as an inflation hedge, TIPS, Treasury Inflation-Protected Securities, and REITs as well, Real Estate Investment Trusts. If you want to learn more about corporate bonds and/or TIPS, check out our Bond Beginners course, as we have whole modules dedicated to both of them. And if you want to learn more about REITs, then our latest member video, linked below in the first pinned comment, may also be of interest. Fidelity also specifically mentions annuities for savers interested in building a guaranteed income in retirement. Remember, when bond rates are attractive, annuity rates are likely to also be attractive, as the insurance companies who sell annuities tend to invest a fair bit of their portfolio into fixed income. Moving on now to Schwab. Like Fidelity, Schwab recommends high-quality, low-risk investment-grade corporate bonds, as well as investment-grade floating-rate debt for investors who assume that rates will stay high and want less price volatility. Neither Fidelity nor Schwab are enthusiastic about high-yield corporate bonds, as the general feeling is that the additional interest you get when you buy a higher-risk bond, the spread, as the market calls it, is too low, meaning that investors are not appropriately compensated for the higher risk on high-yield bonds in the current environment. So Schwab's guidance is to only buy high-yield debt in moderation, and even then, only if you assume that the strength of our economy continues, because high-yield debt is usually a bad bet when the economy gets into trouble. For investors in the highest tax brackets, Schwab thinks investment-grade munis may also be something to consider, as some are offering near 7% tax-equivalent yields, as you can see here from this recent new issue muni offering from the New York City Transitional Finance Authority. Also, munis tend to see less volatility, less price fluctuation, as the market is more dominated by individual buy and hold to maturity investors. The flip side of this, though, as our muni fans know, is lower liquidity. And for those of you who've been asking about preferred stock, which is not fixed income but generally has some characteristics very similar to fixed income, such as a fixed coupon, Schwab does give an honorable mention to preferred securities for 2025. While the yields on preferred securities are not necessarily outstanding at a first glance, they can offer a tax advantage if their payouts can be classified as qualified dividend income and taxed at capital gains rates. Drop a comment below if you want to learn more about preferred securities, and if there's enough interest, we'll see if we can pull together some videos this year on them. So, as you can see from the summary of the 2025 market outlook from Vanguard, Fidelity, and Schwab, there are some similarities in terms of the terminal Fed funds rate and investment ideas, for example, but there are also quite a lot of differences. Our Diamond NestEgg regulars know from these recent videos in 2024, linked below in the first pinned comment for your convenience, that when it comes to U.S. economic resilience, our perspective is most in line with Vanguard's optimistic outlook here. We believe there are fundamental sustainable drivers behind our country's growth, structural advantages which the U.S. has that other countries don't, which could result in further economic expansion. All we need to do is look at the world's most valuable companies by market capitalization. 13 of the top 15 are American at the time of this taping. And as someone who's spent over 15 years living and working across Europe and Asia, I dare say that one of the reasons for the economic resilience of the US is our overall friendliness towards business and entrepreneurship, something that can't easily be replicated overnight by any country. And if our new administration continues down a similar path of overall friendliness towards business and entrepreneurship as the market and we currently expect, then the US economy should be poised for further growth in 2025. That said, there are at least 3 risks that we need to be aware of, with the first being trade, tariffs, immigration, and other policies under the new administration. A lot is being said at the moment, but in our opinion, the reality is that no one knows yet what is actually just being talked about and what will actually be implemented. The second risk is one that we cover often on this channel, our growing budget deficit. I think I repeat myself often enough, so if you need a refresher on this, check out this recent video here on the US debt crisis, link below in the first pinned comment. Here, again, we have to take a wait-and-see approach, as our growing budget deficit will also depend on the policies under the new administration. Scott Bessent, as the nominee for Secretary of the Treasury, has made some statements that he sees reducing the budget deficit as one of his priorities. But much will depend on the details and implementation plan. The third risk is another one that we've discussed frequently here: persistent inflation. Vanguard expects core inflation to stay near 2.5% throughout 2025, above the Fed's 2% target. Fidelity expects close to 3%, and Schwab sees inflation risk up, but does not appear to have published an official prognosis. Only time will tell if the new administration's business-friendly initiatives will outweigh any potential negatives that may arise as a result of potential tariff and immigration changes. But as I mentioned earlier, like quite a number of market participants, we do continue to feel that the U.S. economy is on a stable path for further expansion in 2025. And if this happens, a Fed funds rate in the range of 3.5% to 4% is not unrealistic. If inflation eases in the coming months, the rate will probably be closer to Schwab's lower range of 3.5%. On the other hand, if inflation continues its upward trajectory, as it has in the past several months, then Vanguard's 4% would be more realistic, or maybe even a tad higher. Who knows? On the short end, the Fed funds rate will set the direction for rates on T-bills, CDs, money market funds, and high-yield savings accounts in 2025. On the long end, if you're building out your fixed income portfolio further, continue to dollar cost average, as rates should still be at quite attractive levels this coming year relative to the past decade or so. Remember that bond yields and prices move all the time. You cannot time the market, and my expectation is that this may be another roller coaster year for fixed income. And in terms of the top bond investment ideas for 2025, specifically these here from Fidelity and these here from Schwab, drop a comment below. Which one or ones do you want to learn more about? Or are there other investment opportunities you want to add to this list? Or are you sticking with treasuries? All right, members, super savers, and bond course fans, I hope you enjoyed this video and learned something new. And as always, if you want to really get up to speed on bond investing and building out your bond portfolio while rates are still quite attractive, then check out this video here on our beginner and intermediate bond courses, which we are in the process of updating for the new year. Or come join our next live sessions in January for our bond beginners course and our YouTube members, where we'll be diving deeper into the latest auctions and all things fixed income. I've linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.